Good morning. We'd all please take our seats. We'd like to call the meeting to order. The first order of business will be to call the roll, please.
Rob Fechner,
Good morning.
Teresa Taylor,
Here.
Margaret Brown, Henry Jones, Fiona Ma,
Represented by Frank Ruffino.
represented by Frank Ruffino, Lisa Middleton,
Present.
David Miller,
Here.
Stacy Oliveras,
Here.
Irena Ortega, represented by Michelle Mitchell, Jason Perez, Mona Pascual-Rogers, Ramon Rubalcava, Betty Yee.
Thank you. Next order of business is the approval of the timed meeting agenda for today. What's the pleasure of the committee? Moved by Taylor. Seconded by Miller. Any discussion on the motion? Seeing none, all in favor say aye.
Aye.
All opposed, no. Thank you. Motion carries. Item 3, Pledge of Allegiance. I have asked Mr. Jones to please lead us in the pledge. If you all please rise. Thank you. Agenda item 4, Executive Report. Chief Investment Officer, Mr. Meng.
Good morning, Mr. Chair and members of the Investment Committee. As you see this morning, we have two standard recurring items. Item 5 is an action consent item, and then item 6 is an information consent item. Then followed by action 7. So if you remember at last Investment Committee last month, we presented to the first reading of the revision of the total fund investment policy. And today we ask for your consideration and action. Today is the second reading, so we ask your consideration and action regarding the proposed updates and revision to the total fund investment policy in item 7. Then in item 8, as you may recall that last month we started an annual program review. We started with two total fund level program with the trust level portfolio management, the TLPM program, and as well as the opportunity strategy, the OS program. So today we'll continue with the annual program review. We'll cover two of the two public assets, global equity and global fixed income, and each one of them is paired with a consultant report. So that's item 8. And then in item 9, we will ask, this is the first reading, the policy revision for the public asset classes, which is global equity and fixed income, where we ask for your review and direction regarding the proposed update and revision to the investment policy of these two public asset classes. In item 10, in 10A, first our consultant will present a report to you how our fund is compared to our global to our peers. And then in 10B, our consultant will lead a discussion with you on information on as an asset class, where they will talk about the delicate balance between our fiduciary duty to the fund, as well as being a public agency, the transparency requirement of the public agency. With that, I will pause to see if you have any questions.
Seeing none.
Thank you. So now we move to back to you, item 5.
Item 5, action consent items. This is the approval of the minutes for August 19th and August 20th. I would recommend making that in one motion. What's the pleasure of the committee? Moved by Jones, seconded by Taylor. Any discussion on the motion? Seeing none, all in favor say aye. Aye. Opposed, no. Motion carries. Agenda item 6, information consent items. Having no request to move anything for further discussion, brings us to item 7. Mr. Meng.
Thank you. So before I turn over to my colleague Dan Bienvenu, I just would like to make one remark. As I mentioned to you in July, from our perspective, as we move to the total fund approach, there are 4 quote-unquote currencies that at the total fund level that should be optimized and allocated by the total fund. And we view these 4 currencies being leverage, liquidity, drawdown capacity, and the risk budget. And as we redesign our investment office to be aligned with the total fund approach, we'll take steps to review each one of the 4 leverage, liquidity, risk budgeting, and drawdown capacity. So at first reading, you saw some language regarding the total fund level leverage policy, and this is only our first attempt to try to synchronize all the actions at the total fund level in the context of these 4 total fund currency. And we'll continue to come back to you with more updates on the investment policy regarding these 4 total fund currency. So with that opening remark, now I will turn over to my colleague Dan, Kit, and Beth to cover item 7A.
Thank you.
Thanks, Ben. As Ben mentioned, Dan Bienvenu, acting COIO. As Ben mentioned, item 7A is a second reading and therefore an action item with proposed changes to the total fund policy arising out of this year's annual review. Please recall that the changes center around 4 main areas, the first being strategic asset allocation and the segment work that we've gone through. The second, centralization of the leverage governance. And as Ben said, note that this is a first step as we migrate away from an asset class approach around leverage and the other currencies to a total fund approach around these utilities. We'll continue to migrate towards total fund and moving things out of the asset classes and into the total fund policy, but this is a first step. The other set of changes you see are around the governance and sustainability principles, and then finally a set of ad hoc changes to improve our policy framework. There are also 2 updates to call to your attention from what you saw in the first reading, and those are really about how policy exceptions will be reported. The first is around what's considered a policy exception when assets are in transition from a new program. To a new program or to a new sub-program, and then the second is kind of consolidating where we do the reporting, and you'll see those changes in Appendix 1. So since this is a second reading, we are looking for action from the committee and approval of this, but I'll pause there and take any questions and also see if you want to hear from either Makita and or Wilshire to comment.
Thank you. Mr. Jones.
Yeah, thank you, Mr. Chair. My observation on the leverage is that I understand it's a total fund, moving to a total fund policy. However, if the total fund policy is 20%, how do you not avoid one of these sub-asset classes going to 50, 60%? So I would like to hear your views on that and also get a response from our consultant, Wilshire, as to how that's going to be managed.
So let me take a first shot at it, and then I'll hand it over to Wilshire. The way that we came to the 20% was actually using the legacy asset class amounts that got us to around 23 or 24%. So then we just kind of rounded down and got us to 20, or maybe it was 25%, but it was definitely north of where we're getting to. As far as how we make sure that we don't have excess leverage in any one of the sub-asset classes, that language is staying in your, what we're currently calling our IPGs, which is our, that's the level that doesn't come to the board in policy, but it comes to your consultants for review. So we have sort of desktop procedures, then we have our IPGs, and then we have our total our fund policies. So the 20% governance at the policy level is centralized, with the IPG still reflecting the legacy limits under your consultants' purview.
And IPG is?
It has changed several times, so I don't want to spend too much time on IPG, but right now it's investment procedure guidelines. We're actually migrating to calling them PRPs, but we'll talk about that at another time. and our excessive use of acronyms. We're trying to stay clear.
Okay.
I still call them IPPGs, so I'm still stuck a generation behind Andrew Junkin with Wilshire. To Dan's point, in our review of this, you know, this is just a step in a process, and I think based on our conversations with staff and the experience there, there's a recognition that this is very complicated and really becomes a risk management issue. To your point, you could implement a 20% total fund leverage by having 100% leverage on a particular asset class, but that wouldn't make a lot of sense because you might put that asset class out of business along the way. So it's not just about minimizing the interest expense for the total fund. Clearly, you want to control the cost and see if you can save money, but it's about matching the characteristics of the leverage with the characteristics of the assets, so you don't have really long assets and really short leverage, or vice versa. So that's a critical component, and that will be, I would say, phase 2 or phase 3 in this process. As Dan pointed out, the existing asset class leverage limits stay in effect through the IPGs, and that is something that typically does not come to the investment committee unless we believe there is a substantial change, at which point we say it's time to take this to the investment committee. So if there is I'm just going to make up a number, a 40% cap on leverage for real assets right now, and staff says we want to take that to 20 or we want to take it to 60. Could go either way. We'd say that's now a decision that the investment committee should make, and we should bring it as an item for them. And then I think, as Dan correctly pointed out, the 20% total is actually slightly lower than the sum of the current asset classes. I think it's important to know that, you should not be, nor do I think staff will, running the fund at the max leverage limit all the time, because then if there's a drawdown, you're automatically in an exception standpoint. And so they're very cognizant of that. But again, that's probably phase 2, phase 3 of this project, to have a more cohesive total fund approach to leverage.
Okay. Well, thank you for that information, because my concern is with leverage. I mean, it was one of the elements of the financial crisis. People leveraged up to the yin-yang and had no way to go and provide the payoff. So that's why I'm concerned about the leverage issue. Okay. Thank you.
Thank you. Ms. Yee?
Thank you, Mr. Chairman. So just along the line of Henry's question in terms of process, so if the allocation exception exceeds that of the original timeline estimate, that would not necessarily come to the board, but you'd work with our consultants just to essentially throughout the process in those instances.
I'm sorry, when you say allocation exception, can you?
So you have kind of an allocation that's tied to the original time, it's estimated tied to the original timeline. So if there are, if they exceed those in the original timeline, I'm just trying to figure out what comes back to us and what kind of would essentially be just part of the internal process.
Yeah, so anything that goes outside of what was originally anticipated would come back to you, right? So we would come to you and tell you we're implementing this new sub-program or whatever it is.
All right.
This is the timeline we expect, for example, the segment work.
Yes.
If the segment work wound up taking 2 years when we expected it to take 1 year, we would certainly have come back.
Okay. Sounds good. Thank you.
Very good. Ms. Brown?
Thank you. Actually, Ms. Yee asked my question, and then I do have some questions about attachment 2, but I don't think we're there yet. Is that correct? Are we on attachment 2?
Yeah,
They're looking.
it's just part of that item.
Yes, I think we can take anything around
Perfect.
item 7A.
Very good.
Great. I just want to be sure. Now I need to get my thing back. So I'm looking at attachment 2, page 41 of 112. I'm just trying to prove to everybody I actually read the material. Thank you, Mr. Ming. That was funny. Under benchmarks, item 4, towards the bottom of the page, it says for benchmark changes and material construction rule changes that require committee approval, review and make a recommendation regarding approval. So I just had a question about, I need some help understanding what is considered material, and can you give me an example of maybe past benchmark changes that required committee approval but would now not require committee approval because of this change?
So that's a great question. Let me start by saying that what we're doing here is just putting our historical practice into policy. We had previously not had it explicitly in policy, but we're just taking the practice and putting it into the policy. As far as what is material, that really is a judgment call on the part of your consultants, and this is what Andrew was referring to earlier. If something is going from, really looking like a fish to really looking like a fowl, it obviously needs to come to the investment committee. If something is really just a ministerial change, it doesn't, and then it's a judgment call where it is in between those two.
Mr. Junkin,
Yeah,
thanks.
I'm trying to think of some examples. I think there was a change in the Treasury benchmark that had no effect on, obviously, quality because it was 100% Treasuries, and no material effect on duration. And so we said that one was, to use Dan's analogy, fish to fish. Had that changed to a Treasury plus high yield benchmark, obviously we're raising our hand and saying that has to go in front of the committee.
So you're helping make that determination whether or not it's material?
We are. So we're essentially stepping into your shoes in that case and saying, on behalf of the investment committee, this is significant enough that they need to make the final decision rather than it being a ministerial change.
Great. And so this isn't actually a change. We're just, like Dan said, we're just taking the current practice and putting it into policy. Do you agree with
Correct.
that statement?
I do. I think prior total fund policy revisions would catch everything from even like a name change from Barclays benchmarks to Bloomberg benchmarks when Bloomberg acquired all of the Barclays set of fixed income benchmarks. And that suddenly was, something that you all had to make a decision on.
Great. I have another question then on attachment 2, page 42, the next page. And I have been concerned about. I know I've raised it, probably not with you, Ben, but maybe the prior year, in terms of the process for prudent person opinions. Now, it looks like we're changing the co-investments under 200 million. It used to be, some of those used to say required, and now it's at MID discretion. And I just want to be, I know we're trying to be helpful so the staff we don't slow you down, right? I think that was the complaint. I heard that having to come to get the prudent person opinion takes a while and you may not be able to act on the co-investment. So why don't you tell me if that's correct?
Yes, so that was the main concern behind the size. In order to have access to the co-investment opportunity, we have to be able to respond in a timely fashion.
And then greater than 200 million, they're MID discretion, okay. And then I do also want to hopefully get it in policy when the prudent person opinion is negative, and then it still comes to the board. I don't understand why that happens. This has to do with the tower project, but I hope in the future we'll get a clear policy on that when the prudent person opinion says we shouldn't move forward, and then it comes to the board, because I'm concerned we will make a political decision as opposed to an investment decision. So do we have that anywhere in the policy now, Mr. Junkin, about when a prudent person opinion says don't do it?
I don't think that's in there. I'm looking around for Makita because I think they probably know all of the PPO requirements in the private asset classes since they are the private asset class consultant.
So if it's under the delegated authority, so it's not over 2 billion.
200 million?
200 million, sorry. I just want to be sure what that process is and that we're following that in the future.
Yeah, I don't think that a negative PPO requires you to not move forward.
Okay.
It is a piece of the puzzle that is the full package of due diligence.
Thank you.
Thank you. Mr. Jones.
Yeah, thank you, Mr. Chair. Mr. Chair, since our roles and responsibilities of our board self-evaluation, we talked about having our consultants chime in on these issues. So I would like to ask that you ask Makita to see whether or not they have any comments or observations on this item, and also respond to Ms. Brown's question about the PPO.
Very good. Mr. Hart, can you please join us?
Good morning. Steve Hart, Makita Investment Group, private asset, private equity consultant. So you see our attachment, I believe it's 5A to this item 5 on the private equity side. Again, looking to work with the staff to help make this co-investment program work efficiently, and recognizing in the marketplace, in the private equity side, the need for being able to be flexible and to work very quickly, in some cases, to execute on the co-investments in the private equity area. And we feel that CalPERS staff knows these private equity managers very well. They know where they are successful, the kind of investments where they're successful, and that providing some flexibility to be able to execute on those investments at a more modest size without a PPO can add to the attractiveness of CalPERS to be able to actually get those opportunities and be able to execute on them. For larger deals, wanting to make sure that not only the MID, but the CIO signs off on those transactions. We think that makes sense. And then for ones that are quite large, to make sure that there is that concurring opinion. We think that it's an appropriate balance to weigh the factors of being able to get proper oversight of the transactions, but also to allow the staff to be effective in the marketplace for private equity co-investments.
And excuse me, Kit Crocker, CalPERS staff, just wanted to clarify in response to the earlier question that if there's a difference in agreement between staff and the PPO, then the issue comes to the board under current policy.
Can you tell me where that is in the policy?
You need your microphone, but Henry's on first.
Okay,
You were on, Henry. You turned it off.
I'm done.
Oh, you're done? Okay. Ms. Brown, push your button, please.
Thank you.
Go ahead.
I just want to know where that is, if it's in writing in the policy anywhere.
It is not in writing in the policy that I'm aware, but it's simply it follows from the fact that of course, if staff isn't proposing we do something, we don't bring it to the board.
Right.
And the PPOs are required under certain circumstances or within MID discretion. Sometimes, as staff often obtains them, whether or not they're required. And then that becomes, as Mr. Junkin says, another factor that the board has at its disposal to consider in whether or not to approve the investment. But if staff believes in the investment, it will bring it. It typically, has the discretion to bring it to the board, notwithstanding a negative PPO.
Yeah, thank you. And I think the concern was the staff was neutral on the investment, which really threw me off. So maybe we could talk about that later in closed session. Thank you.
Thank you. Ms. Oliveros.
Hi, sorry, can I take us back to attachment 1? Oh. Sorry, can you hear me? Okay.
Yeah, you're on.
Sorry. Okay, this is going back to the CMOs that Mr. Jones spoke about. So I understand that they're excluded from the definition of derivatives. What's our plan if something happens in the market and there's illiquidity?
Ms. Oliveris, what page are you referring
I'm
to,
on
please?
page 13.
And so the question is, if CMOs were held in the portfolio and were to become highly illiquid, what's the plan? Is that? I just want to make sure I'm clarifying the question.
I understand at the top of page 13 it says that they're excluded from the definition of derivatives.
Correct.
So if there's illiquidity in the mortgage market, what happens? Because they are a derivative. I mean, that's what they are, right? But we saw in the housing crisis when there was no secondary market for those securities. So what's our plan if there is no liquidity?
I would say our plan is similar to what it is with all the other illiquid assets that are in the portfolio. So we certainly, to Ben's point on these 4 critical utilities, where leverage was one we talked about, liquidity is another. We're very focused on managing the liquidity of the portfolio. Just like if suddenly small cap equities became illiquid, or similar to the way that private equity and real assets are illiquid, we manage the liquidity through managing the liquidity in a very careful and concerted way. If these were to become illiquid, they would not be in our toolkit as something to raise liquidity.
Yes, but we don't treat them as derivatives. It sounds like here we're treating them as cash. Is that correct?
No, we're treating them as the assets that they are.
So, but not as derivatives.
But correct, not as derivatives. Similar to we say, we don't own convertible securities, but similar to convertible securities, similar to, spot FX, you could argue as a derivative. What we're saying is that from the derivative limits that we're using, we're not considering CMOs derivatives.
What's our exposure?
I'll ask Arnie to speak to that one.
Thank you.
Good morning. Arnie Phillips, Managing Investment Director, Global Fixed Income. So historically, I get the question that whether CMOs are derivatives is a gray area. We have never historically defined them as derivatives. As for exposure, we have almost no CMOs anymore in our mortgage portfolio. When I first started here 2+ decades ago, we used them quite a bit against Treasury holdings. The purpose of fixed income has changed a lot since then, very siloed back then, very total fund focused now, and they're just not as good a fit from a fixed income perspective as they used to be. So we have almost no CMOs currently.
What's almost no?
I didn't want to say zero. I think it's pretty close to zero. We have thousands of holdings in the mortgage portfolio, so I wouldn't want to put it at zero, but it's closer to zero than 10%.
Could you narrow that range for me a little bit?
10% of overall fixed income. I think it's almost nothing, even in the mortgage portion, which is 50% of the spread segment, which is not much of overall fixed income. So I would put an extremely immaterial amount, if we even have any.
So why don't we do this? We can go back to get the exact exposure in CMO, and then we send the email to you.
Thank you.
Yeah.
I had a question about, let's see, on page 14, and I think this was discussed earlier too, about staff's direct control not to exceed 20%, and this is getting the leverage that Mr. Jones discussed. What has that percentage been in the past?
I would say in the past it's been around 10%. It goes to how you define leverage, but we do own some CLOs, and then we have those overlaid with historically with equity assets. Now they're being overlaid with Treasury assets. We call that leverage because of the fact that the CLOs aren't technically cash. And then there's some leverage elsewhere in the sort of the real asset program and others, but in aggregate, it's still well below the 20% limit. To Andrew's point, we're not looking to lever the plan up. We will come back to you as we explore that and try to achieve 7%. But right now, the leverage is I would say south of 10% at the plan level.
Okay. And then page 16, on divestment. I've read the definition of divestment here, and it seems that we have divestment, sustainability, and then ESG. And I'm wondering how we're integrating all of this, because it's clear we don't have a divestment policy. We're seeking sustainability with our fund, and then we are looking at the ESG of our investment holdings. And so I'm wondering if there's a way to integrate all these things so that we're taking one approach.
I'm Beth Richtman, Managing Investment Director, Sustainable Investments Program. So when we talk about ESG, we're talking about it from a risk and opportunity lens that we overlay on our investment decision-making process. It's not necessarily about, excluding anything from our portfolio. It's about understanding the full spectrum of risk and opportunities that can act on those investments over time. So you could think about it as a process. That is something that we're working on throughout our investment office, through our various asset classes, and bringing that into our investment processes and our decision making. When you think of divestment, that is an exclusion from a portfolio, usually based on, as it's in practice in this field, not based on just the investment merits of the particular issue. It's based on a decision, and this is sort of described in this policy. Let's see. First paragraph, thank you. So this is for the purpose of achieving certain goals that do not appear to be primarily investment related. So it's promoting other things. Yes. That's sort of how we think about divestment. And that's why we separate the two. Because when we think about ESG integration, we are thinking about it from the perspective of, as a way of practicing our fiduciary duty in terms of prudence and care, and really understanding the complete spectrum of risks and opportunities that can act on an investment. The one other thing I would add related to just, if you're thinking about the taxonomy of the sustainable investment space, is impact investment is also a term that gets used. That is when an investment is made by an investor like us. We'll talk about it from a fiduciary's perspective. So an institutional investor would make an investment because of the financial merits of that investment, but also on top of that, it would achieve environmental or social outcomes. So that practice can be very aligned with the way an institutional investor like CalPERS would approach investing, as long as that investment would stand alone on its investment merits.
Thank you. Yes, I'm aware of those definitions. Okay. I was wondering if it might make sense to, when we're looking at the sustainability of CalPERS as a fund and how this needs to last for many generations, and we have different language that touches many other areas, I think we need to have a more holistic approach. So it's just something to...
Kit Crocker, CalPERS staff, just to... we have, in a sense, kept them intentionally separate because one is a compliance exercise that's actually handled under my group. And so an example would be the Iran-Sudan divestment legislation that was put in place in 2011. And we have, the legislature has mandated that, consistent with our fiduciary duties, we undertake certain analysis and divest if certain companies meet the threshold requirements for divestment, subject to, again, to the fiduciary duties. But that is quite different. The one reason we like to separate them is because, as Beth says, we want it, the ESG and sustainable investing is really through an investor's focus and lens. Mm-hmm. What it will benefit the fund most in the long term, the sustainable aspect. And we need to, from a compliance standpoint, on the other hand, adhere to board directives and legislative directives. And that's a different sort of lens.
Yes, I'm aware. Thank you. I wanted to move on to page 28. And this is Appendix 1, reporting to the investment committee. I wanted to talk through the frequency of reporting. So the first item, number 1, the total fund to all programs. So as I'm reading this, and I want to make sure I understand this, if there's some policy exceptions or other issues with the total fund, the report to the investment committee would be at the next committee meeting or sooner if deemed necessary. If we're going to quarterly investment meetings, I'm concerned that the board might not have the information as soon as they need it.
So we can certainly look at including those in the insight tool. This language, candidly, is based on the... Recall that the first reading of this policy was actually before those changes were discussed at the board meeting on Wednesday in August. We can certainly look at making sure that we get those out on the insight tool. I will say the policy exceptions are They're called exceptions because they're very exceptional, they're very rare, but we can find a way to make sure those get in front of the board. I would also say that there are two kinds of things. One is a policy exception that is reported that requires action. We need to either say we want to keep it in place because of some reason we want the exception to stay, or requires remediation, and then there's others that are just FYI, and we do need to look to bifurcate those and look at the insight tool and how to make sure that we get the committee the information as quickly as they need, while not, and of course we always have the ability to schedule a one-off meeting that could always be called with 10 days notice if it's something that we do think that the board needs to see ASAP, but we'll look at how to use the insight tool also.
Yeah, I think we would need more clarity in terms of what the board would need to see.
Right, and I would say this is another place that we would really look to the consultants to exercise that judgment. We very much look to the consultants to be the sort of day-to-day eyes and ears for the board.
Thank you.
And if I might add, in the 4 years I've been here, I've not seen a policy exception that was anything other than an information item. In other words, we were not coming to the board for assistance in resolving the item, which typically they're resolved before they even come to the board. So I think one way to look at the policy exception reporting process is it's a way to keep staff honest and make sure that the board is aware if we're not staying within our board-directed guardrails.
Right, and then on page 29, it's just the frequency of reporting to the asset allocation. And I'm hoping that with this new tool, we would be able to log into something and see how the assets are allocated, so that maybe we don't have to do reports. Would we be able to get all the information we need and then check in as frequently as we want, or?
Correct. The idea would be to report on the insight tool to report what the strategic asset allocation is and what the portfolio's allocation is relative to that. The idea is to present that.
And would that information be made current monthly in some cases if those are private assets, or? I'm assuming it's not going to be real time, because I understand that would be very challenging.
The idea would be monthly. It certainly would not be real time. The idea would be monthly, recalling, of course, that on the private assets, to your point, those valuations are lagged 3 months and then they're stale for 3 months, right? Because we only value those quarterly. So the private assets would stay stale and lagged. The public assets would be an updated snapshot as of the month end, reported to the board through the insight tool.
Yeah, and Ms. Oliveros, one of the process steps that we will do is each of the board members will be interviewed directly as far as the types of information and data that you would like to see in the insight tool.
Fun. Thank you. On page 34, divestment. As I read this, it seems I'm a little unclear. So an independent could be hired to evaluate the need for divestment. Is that at the committee's discretion, or is that staff's discretion?
It's always at the committee's discretion, but historically, staff has also engaged people to do the valuations as well.
Thank you.
But certainly, if the committee were to ask for it, the committee directs it, and we would, of course do that.
Okay, thank you. On page 39, private equity program related responsibilities, this gets to reporting. So it seems there's a lot of, this gets to the authority that's been delegated to staff. I'm curious as to the thinking about the opinions to the board that are not required, especially for those investments that exceed staff delegated authority, or at least that's how I'm reading item 4.
I'm sorry, Ms. Olivares, can you please repeat the question?
Sure. So it's I believe it's item 4, items or transaction types or sizes that exceed staff delegated authority. And it seems that that's required for an opinion to the board. For customized investment accounts, there's no opinion to the board. For co-investments of a certain amount, there's no opinion to the board. What's been our past practice on that?
And are you referring to private equity specifically?
Yes.
I'll ask if Sarah can help us with that one, please.
Sarah, Core Investment Office. Opinions are required for the board only if investments exceed staff's delegation, and the board is required to make an opinion or make a decision.
And that's been the past practice for
At least 20 years.
Okay, thank you. Page 46. This has to do with benchmarks. So the private equity benchmark, I think I brought this up at the last meeting, shows as FTSE All World, all cap equity plus 150 basis points. So that's taking a basket of publicly traded stocks that are, you can sell the next day, right? And then adding 150 basis points onto that. I'm wondering why we're not using some type of private equity benchmark like top quartile, median IRR, and instead we're using publicly traded securities.
You know, benchmarking the private assets is a challenge, and if you look at the history of our benchmarks in private equity, there was a period where we used a peer universe type comparison. Where we've ultimately settled is that private equity is held as as another way to harvest the equity risk premium, but as an illiquid alternative to public equity. But the opportunity cost, so to speak, is public equity, and so that's why we've settled on a public equity, but then also 150 basis point premium for that, for that illiquidity.
Yeah, and the other thing you may recall the last time we talked about, there are also practical limitations to a private equity benchmark. Given the size of our fund, we cannot easily find a private equity benchmark that is representative of our portfolio. For example, there are private equity benchmarks that include smaller funds that we don't easily have access to, or they include some other kind of VC fund or credit fund, which we don't have in our portfolio. And also, as you know, that all these private benchmarks that self-reported. So there is biases such as survivorship bias, selection bias, looking back bias. So because of these biases and plus the practical limitations, we chose to use a public equity plus a premium benchmark that's more relevant to our portfolio.
Would you say that most of our private equity holdings are first quartile, top quartile?
Ex ante, when we pick them, we try to pick the top quartile managers, but ex post, there are managers that's in second or even third quartile.
So then we would be looking at, do we have any in the fourth quartile?
Oh, in our portfolio, do we have fourth quartile? I want to say at some point, I'm sure we did. But also the quartile analysis, you have to be mindful of which universe you choose and what time period. So this is all in a way subjective. So that's the challenge with investing in private markets, the availability and transparency of data. We don't have a lot, not just us, the industry doesn't have a lot of data. It's a luxury of public market asset classes. We have abundance of data. You can slice and dice any way you would like to. But in private market, we are really limited to the availability of data available to us.
Right, so we could sort it by vintage, and you could still look at the top first and second quartile, and then median IRR, and then do that for those funds for which that information is available. I'm thinking that we would have a different result, though, in terms of a benchmark than all cap equity at plus 150 bips. That seems really low for the additional risk we're taking and the additional cost.
At our size, yeah, but leave it to Sarah.
So we do look at the performance of all of our funds by vintage years. Clearly, there are some that have underperformed our expectations. There are some funds in the portfolio that are third and fourth quartile, but overall, it's above median for the performance.
So I've seen other pensions use median IRR for first and second quartile insurance companies use that too. Are any other pensions using this benchmark where it's all cap equities plus 150 bips?
Can I jump in on that one? Because I think with our breadth of clients, I can answer that one pretty easily. The answer is most pension funds use public equity plus a premium. And if you pay particular attention to this page, this is what rolls up into the total fund benchmark. So you can't roll up an IRR and time-weighted rates of return. Mm-hmm. So in the private equity annual review, Makita provides a whole host of comparative data. Staff does as well. And I think a lot of the benchmarking that you're looking for by vintage year, things like that, that happens there. So you're getting that information there. This is specific to the public fund roll-up. And I would say every one of our clients, probably for the public fund roll-up, has to make this concession. It just doesn't work otherwise.
Is it the same premium?
No, the premium varies. It's broadly come down, and we've had this discussion before. And some people use S&P 500, and some people use Russell 2000. It depends on the nature of their portfolio and how tilted it is towards venture or buyout or geography. But I would say what used to be standard was probably S&P 500 plus 5, and then starting about 10 years ago, it started moving down. I would say the number these days is probably something like plus 250 or 300 in most cases, and this is lower, which speaks to Ben's comment about deploying 10% of $375 billion means you do end up with some third and fourth quartile funds because you deploy capital across a much broader spectrum.
And also, I haven't seen funds use both of them, both benchmarks, but for different purposes. For example, as Daniel mentioned, that using public equity plus a premium, that's almost like opportunity cost model. If we don't invest in private equity, we would put our money in public equity to gain the exposure to growth, right? So for longer-term strategic asset allocation, I haven't seen funds using public public equity plus a spread as the benchmark. But then for evaluating the staff, I haven't seen funds using their peer group, exactly what you said, a vintage year. How is our fund in the same vintage year compared to the same vintage fund in some of our peers? So in that way, we can use that metric to evaluate our staff in terms of manager selection. Did we select better than average manager or not? So I haven't seen funds using both benchmarks for two different purposes. One for longer-term strategic asset allocation purpose, and the other one for shorter-term evaluation of the staff.
One of the newer methodologies that's getting a little bit more traction is the public market equivalent, which essentially you buy and sell imaginary units of whatever index is your benchmark with the same timing as your cash flows. But again, that would be part of the private equity annual review. It wouldn't be part of the total fund benchmark here.
So I'm sorry, still not clear on the 150 bips, where we fall relative to others. You mentioned S&P plus 500 before, somewhere
Yeah,
300.
I would say it is on the lower end of the market. So the current probably median plus is 300.
But I think really, sorry, go ahead.
Oh, I was just going to ask, how did we get to 150?
Yeah, I think the size, we really had to consider our size. The larger you are, the more difficult it is to achieve the excess return. And if you recall from Hero's presentation from GPIF last month, right, they are run $1 trillion fund, 2.5 times larger than we are, but their desired return is much lower than ours as well. So when we try to get 10%, as Andrew said, 10% of $380 billion to deploy into private equity. Given that size, it's just much more challenging and difficult to achieve the same amount of excess return by a much smaller fund, like a university endowment. So that's a reality we had to face.
Yeah.
The one other thing I would call your attention to is just the difference between arithmetic and geometric, right? So One of the reasons why we settled on the 150 arithmetic is because that actually translates to more like 250 geometric, just due to the multiplicative process. So we had historically had a 300, which actually translated almost 500, geometric. And so that was one of the other rationale, was to use an arithmetic 150.
Yeah, this causes me some concern. That's all my questions.
Thank you. Ms. Mitchell? Oh, hold on. Go ahead.
Thank you. Going back to the prudent person opinion quickly, just a couple of things. I understand that you're raising it because you want more flexibility, you want things to be able to move a little faster, but can you tell me how you landed on 200 million, and then what percentage of your investments fall between 100 and 200 million typically?
Maybe I'll ask Makita to take on the percentage of investments. I'll say, as far as landing on 200, it was just finding a way to balance between what Ben was saying earlier, the ability for us to actually be responsive and deploy assets in the co-investment space. That's how we bring our feed. One of the main ways we bring our feed load down, right? So we needed to find a way to still be able to execute while still having some limits that would give, the committee and frankly the staff some comfort around when to bring in PPOs. But as far as the percentages, I'll maybe ask Makita to comment.
Thank you.
Steve Hart, Makita Investment Group. The CalPERS has not been executing co-investments for a few years now, so we don't have updated data to see kind of what their transaction size in today's market would be. The staff did do some research relatively recently looking at the managers that they have as part of their core portfolio and looking at their examining how they have deployed to their other LPs, other co-investment opportunities. I don't have statistics exactly as to where things come out. I just kind of, as a rule of thumb, that a $100 million co-investment would be probably for CalPERS somewhat middle of the road, and the $200 million would be on the larger side. It would be for pretty large transactions to make that happen. It's a little hard to tell. We don't have the data from their portfolio to see, but thinking of other similarly sized programs, that's kind of where we might come out. So it's hard to say with any specificity on this, but again, looking to try to be efficient about using the PPOs and involving staff's discretion versus having a third party involved in the process.
Thank you.
Mr. Jones.
Yeah, thank you, Mr. Chair. Ms. Reichman, the response to the question about impact investing, and you mentioned that it's a two-step process. The first step is to make sure that it's having a social impact, and then the second step was investment returns. And I just need to understand that the driving factor in that process is investment returns, as opposed to just being able to respond to social good.
Beth Richtman, CalPERS staff. Yes, maybe if I reverse the order, I'm not sure, but the first step is to make sure that any investment has financial merit. What I'm saying, though, it doesn't preclude us in investing in companies or industries or investment strategies that additionally, on top of an attractive financial return, would also have a social or environmental impact that could be measurable. And there are investments in CalPERS portfolio, for instance, our energy optimization initiative, where we're making the investments in our real estate portfolio because they're attractive financially first, but also they're reducing our greenhouse gas impact in a way that we can quantify and track. Hope that answers the question.
But Mr. Jones, let me just, you use the term driving factor. I'll even say, take it stronger, the only factor, consistent with our fiduciary duty, the factor is an investment factor, how it's going to pay out. Now, if it has these other benefits, terrific, but Ours is a fiduciary responsibility, and we will look at these through the lens of how the investment outcome, we expect the investment. Now, we're obviously making decisions in the face of uncertainty. That's investing, but it is about the investment return.
And the one additional thing I'll add that I think Ben mentioned at the last board meeting is that he's asked me to actually work on an ESG framework that I think will be helpful in answering Ms. Oliveira's question and also Mr. Jones's question about how we're going to approach integration across the fund.
Thank you. So no other requests? Anything else on this item?
So this is an action item, and we would look to the committee for approval.
Been moved by Jones, seconded by Taylor. Any discussion on the motion? Seeing none, all in favor say aye. Aye. Opposed, no. Motion carries. Brings us to agenda item 8, information agenda items. Mr. Meng?
Yep. Thank you, Mr. Chair. Again, so the agenda item 8 will continue the annual program review. As I said at last IC meeting, we covered the two total fund programs, and today we'll cover two public market assets, global equity and global fixed income. And then at the next IC meeting, we'll cover the two private assets, private equity and real assets. So without further ado, I turn over to my colleagues to cover item 8A, global equity annual program review.
Thank you.
So again, Dan Bienvenu, this time wearing my MID of Global Equity hat. I'll have a brief introduction here, and then we'll be happy to take questions. Global Equity's role within the investment office is really centered around systemically harvesting betas in three main areas. The first area is cap-weighted global equity. That's attempting to harvest the standard equity risk premium. And by equity risk premium, we're talking about earning returns based on corporate and economic growth. So corporate earnings growth and economic growth. The second is the factor-weighted beta that we've talked about. It, again, is trying to harvest that economic growth and corporate earnings growth, but also through the lens of mitigating severe drawdown. So those are the first two betas, and those two betas accrue to the PERF, the Public Employee Retirement Fund. That's a $380 billion portfolio. The third set of betas that we're looking to, and I'm sorry, global equity is about half of that $380 billion. The third set of betas that are harvested in global equity has to do with the affiliate program, and those span across the asset classes. Again, harvesting these systematically harvesting these betas to earn the asset allocation of those trusts. And really, the last thing I would say is we put up here culture. This culture is something that the organization is spending a lot of time focusing on, and really this is about investment belief 10 for us. It's all about strong process and all about teamwork and really working in a healthy culture. Okay, figured I'd call your attention to a handful of the major accomplishments that were achieved in global equity in fiscal year 18-19. First, the implementation of the strategic asset allocation, both for the PERF, which was the asset segment work, but then also the new asset allocation for the affiliates. And this is some of the stuff that Eric talked about in the trust level review last month. Also continued work reducing the complexity of global equity and integrating ESG in our decision making. Again, all about the investment outcome. And then finally, I'll call your attention to the launch of the California Employers Pension Pre-Funding Trust, or the CEPPT, if you'll recall that, was approved in June and then launched. For the upcoming fiscal year, really the focus is in another handful of areas. First, continuing to reduce complexity and to execute on our ESG 5-year strategic plan. Secondly, leveraging technology and data, including migrating from disparate platforms that the public assets are managed on to a common platform for the public assets. And by the public assets, I'm referring to public equity and global fixed income, which are the program reviews you're hearing today. And then finally, continuing to work on the best way to harvest that equity risk premium in terms of CalPERS utility for way to earn returns to earn, work towards that 7% at the PERF level. And then also looking at interactions between public equity and private equity and trying to really sort of blend those. So through the lens of Ben's 4 Ps, so far we've talked about portfolio, process, and people. That takes us to the last one, which is performance. And on slide 6 here, you can see the performance of the portfolio. Performance, of course, depends on what time period one looks at, But by way of summary, I would say the absolute performance contribution to the PERF is positive across all time periods for global equity, and quite strong longer term. The 10-year number is nice. Now that, I think last year at this time I got the question on when the global financial crisis rolls out. Now that the global financial crisis, while it was in the numbers, everything looks not very good. As soon as it comes out, the numbers look definitely better. It is now out of the 10-year performance number. Relative performance, again, quite strong in the 10-year number, more challenged in the shorter term, candidly, mostly due to underperformance in the last 18 months. Then on to slide 7, I'll call your attention to the performance of the affiliate trusts, where it's very varied, of course, just due to the disparate nature of their allocations, due to the disparate missions of the trusts. But in aggregate, I would characterize the performance as falling in line with expectations. So that's a high-level overview of global equity, but certainly happy to take questions from there.
Thank you. Ms. Brown.
Thank you. Dan, I just have sort of a process question for you, and I think I've asked you this privately, but I do want to ask it for the full board, which is, how do you balance wearing both hats? The COIO, which is, I call that position the traffic cop. You might tell us what you consider that that role is, and then also wearing the global equity MID hat, because those conflict. So I'm wondering how you do both.
Well, I like to think the only way they conflict, candidly, is from a time standpoint, and it's been busy. Right, the days have been long. But as I say, that I don't think there are conflicts in terms of the roles. It's more just been a time thing. It's been, the history of the COIO's office was to be sort of that traffic cop. In June of this year, we actually migrated all of those things that are more sort of compliance type activities actually from the investment office over into the enterprise under ecom, really allowing the entire staff of the investment office to be focused on the portfolio management outcome. So in that sense, I would say that that any conflicts that had existed now no longer do. That's all the first line. All of the investment office is that first line of defense, managing the portfolio and certainly managing the risks, with all of the sort of second lines of defense being in ecom.
Yeah, and also if I may something, before we named Dan Bienvenu as the interim COIO, we thought about this potential conflict. And if you recall, as we explained to the full board twice in the past, when we announced the Dan becoming the interim COIO, we moved the potential area of conflict to be under Eric Bergson. And that was the solution for the first half of the year. And then as Dan mentioned, that since June this year, part of that function had been permanently moved to ecom area out of the investment office. And on this note, also, I want to take this opportunity to thank both Global Equity team and the COIO team, the operation team. As you have read in Wilshire's report in annual program review in Global Equity, they went on to elaborate on their compliments to the stability and flexibility of the Global Equity, so that they offered this opportunity for us to steal Dan Bienvenu from Global Equity because of the deep bench and the long-tenured staff in both Global Equity and in the COIO office. So we are really fortunate, to have this kind of flexibility and deep bench in both of the areas, so that Dan could wear both hats at the same time. So with that, I really want to thank both teams. They all have stepped up. And as you notice that in the investment office, we have a few vacancy positions, and we have a number of senior managers wearing 2 hats now.
And we're filling the COIO soon?
The personnel discussion, I'm not allowed to discuss in public.
Oh,
but yeah.
Thank you.
Ms. Brown, I think the only thing I would say there is that it's more important for us to find the right person than to find a person quickly. And so Ben being here roughly 9 months now, and making sure that we have complementary skills within Ben's direct reports. And so I think the discussion that will happen at Perf and Comp will give you a little more insight into what we're thinking around the creation of a deputy CIO role, and then we'd be ready to begin recruitment on some of these other key positions.
Great, thank you.
Thank you. Ms. Taylor.
Yes, thank you, Mr. Chair. Dan, thanks for your report. It was really clarifying. I just wanted to kind of give a shout out on your governance and sustainability integration, and kind of go a little further into what you answered to Henry in terms of with Beth and the impact fund. Obviously, our governance and sustainability are our SDIs. We always are looking at risk and reward, even with our SDIs. I absolutely agree with that. But it is the board's strategy to implement the ESG strategy across our portfolio. So I'm glad to see all of this work that you guys have been doing in our global equities on our ESG strategies. And I just kind of wanted to call out our Climate Action 100 Plus and our work on that, our work on our corporate board diversity, because it's so important as we see the issues with the climate that are, they're overt at this point. It's not like it's not happening and it's sort of far in the future. We're seeing impacts now on real estate, all kinds of things that are a risk to our fund. So I just wanted to give you guys a shout out on this work. It's really good work. I'd like to see us highlight that more often. And it was really important as I went to PRI, and PRI worldwide is considering climate change urgent at this point because of the risk it poses to everyone's portfolios. But also, I just wanted to kind of go into corporate board diversity a little further. We're engaging with companies to improve corporate board diversity and use proxy voting and share owner campaigns to bring about change where engagements have not led to positive outcomes. I don't know if you want Beth to speak to this or not, but it was, what I'm trying to figure out is when there have not had positive outcomes, what are some of our solutions as we're engaging with those companies?
And I'll ask Samiso to come up and answer that question, but as he's making his way up, I'll just thank you for your comment around the work. There's been a lot of work to integrate ESG and all the investment decisions that are being made, and that's been candidly a lot of work across a lot of people. So certainly Beth and team, Samiso and team, and Simpson and company, it's been a lot of work. I do think there's been a lot of successes, and it'll remain an area of focus, but thank you for the comment. And I'll also underscore what Ben said and kind of back to Ms. Brown's comment before I let Samiso talk, sorry. I have made this comment several times. It has only been the fact that the two teams, both the COIO's office and the global equity, the senior leadership and the whole teams are as strong as they are, that one could do both jobs for an 8-month period, and we'll see how much longer it is. It's only been a function of how great those teams are, and so I really want to underscore that comment. So, but Samiso, with that long preamble, I'll let you answer the question around board diversity.
We have a lot of confidence in you, Dan.
Thank you. I appreciate it.
Thank you. Samiso Nzima, Investment Director, Global Equities. So to the question of corporate board diversity, again, if you look at what has happened and what we've achieved, especially with the 53% of the companies that we engaged, actually adding, level of diversity that I didn't have. Where the engagement is not working, we've actually voted against, directors in those companies. Whether we vote against board chairs, nominating and governance committee members, as well as long-tenured directors. If you look at the number of directors we voted against this past season, which is 255 at 97 companies, that's a lower number than we did in 2018. And in 2018, we voted against 468 directors at 145 companies. To me, that actually shows progress that we've made, that we're actually voting against fewer directors at fewer companies. If you recall, in March when we came to the investment committee, we reported that about 40% of the companies that we had engaged had added, a component of diversity that they didn't have, and as you see now, that number has moved to 53%. So there's been progress in there. And the other thing that we're doing as far as holding companies accountable is that there are companies where they don't have majority voting. So if a company doesn't have majority vote standard for director elections, even if 99.9% of shareowners vote against that director and the director just get one person voting for them, they stay on the board. So what we've done is at companies where they don't have diversity, and they don't also have majority vote for directors, we filed shareowner proposals to actually have these companies adopt majority voting standard and we'd identified 114 companies at the beginning of the year, and we've had many settlements with those companies. Some of those are companies that had not responded to us initially, over the 2-year engagement period, but have now responded. So there are a lot of tools that we are actually using in terms of trying to address this issue.
Thank you. And so I think I wanted to kind of expand on that. And I know that further in our presentations here, maybe not under global equity, but under one of the others, I'm trying to see if it was here or not. We have, I think we're having success with getting more women on boards. I'd like to see the numbers of success in other races. I think that might be an issue on corporate boards. So I was wondering if that's also something that we're targeting. Not just, we're having a little more success with women, and now I think maybe we should move on to the races in terms of being equitable.
Yeah, so in terms of the criteria that we've used to identify companies, really, we've used gender just because, that's the data that's available. So some of the challenges that once you start getting into race and ethnicity and other forms of diversity, the data is not there. But what we've seen is that where companies lack gender diversity, they also tend to lack other forms of diversity. And when we engage companies, we actually are clear to them that the identification criteria may have been gender, but we're looking at all forms of diversity and not just gender. And, we are working with, talking to different affinity groups, for example. What we've sort of suggested to them is that those that have, if they could encourage their membership to self-identify in terms of race and ethnicity and so forth when they actually, list in some of these databases, that would actually help in terms of getting the information available. We have in the past, we filed a petition with the SEC, Human Capital Management Petition. Again, one of the things which we're asking for is that to have some of that information in terms of being disclosed by companies. But we're not at a position where there's mandatory disclosures around, diversity from the SEC. So we're trying to work all angles in terms of trying to get the data out there, either from a self-reporting perspective or from having the SEC sort of have a mandate for companies to report that data.
So one of the problems we have with ESG integration is data. It's always been the case. I was wondering, can we tap into EEOC data for this?
So as part of our principles update, one of the things that we've actually identified and put in the principles is actually to encourage companies to report that data. Because when you think about it, the EO1 data is already out there, it's already reported by companies, not even an issue of, companies will say, well, it's costly to collect this data and make it available. It's already reported under federal regulations. So it's data which, if companies actually wanted to make available to investors they can. So one of the things we're trying to do is to encourage companies to do that, and hopefully we'll get more companies to do that. I don't know if Beth wanted to add something on that.
I'm Beth Richtman, CalPERS staff. I was going to add the comment, which is great, that the principles you just approved, the update does include that information. Additionally, as part of our strategic plan, we recently did a diversity and inclusion survey of our external managers, and one of the questions we asked was about their process for nominating portfolio board company members. So basically, for our private equity or our real assets, are they looking at these criteria when they're selecting members for their portfolio company boards? Which is important because board experience at even the private company level can lead to the type of skill set that then would allow someone to be on a public company board as well.
Great, and I appreciate all your work on this, because I know how difficult it is when we're lacking data, when the SEC isn't being cooperative in allowing us to get majority vote. So I just want to, it's so important that we continue to focus on this, because as we know, the more diversity on a board, the more likely we are to lessen the risk of that company and the impact that company could have in terms of a drawdown.
The one other thing I would add is that it does become a bit of a challenge for international companies because of the type of maybe laws in place about reporting,
right,
which may mean that and they also aren't subject to the EEO-1 data requirement.
Right.
So it is, as we think about it as an international level, we do have to be nuanced.
It's almost all U.S. Okay, yes. Thank you.
Ms. Yi.
Thank you, Mr. Chairman. First, thanks to Dan for wearing multiple hats and really doing a great job on both. Really appreciate the work. I wanted to go back to slide 6, if I could, on the performance summary chart. And as you say, we've kind of gotten through some of the rough year horizons and approaching a pretty strong place with the 10-year horizon. But I was wondering, in terms of the underperformance in the 1, 3, and 5-year periods, whether that kind of informs your thoughts maybe differently or more expansively about how you evaluate benchmarks and kind of the work that you're doing this year in the whole area of benchmarks.
Thank you for the question and for the comment. Your performance always has to weigh into how your ongoing evaluation, and one of the simultaneously most challenging but also most interesting parts of investment management is striking that balance between being humble enough to feel like maybe you missed something and you can learn from it, and always be learning, but also maintaining the strength of your convictions as a long-term investor. And I would say that that's the exact balance that we're trying to weigh. We are certainly exploring benchmarks and looking at what we think we should have in our benchmarks. How expansive, all of those things. And I'll just call your attention to sort of the value factor as one of those things. Value. There is a ton of academic literature that talks about how the value factor works, and our portfolio has a sort of a systematic exposure to value. Candidly, for the past 12 years, and especially over the last 2 years, value has underperformed. So you have to just ask yourself the question, has the world changed such that there will no longer be a return premium to the value factor, or do we think that you'll get a reversal of this, and a lot of times those reversals happen in a very quick and snapback fashion. And that's one of the things we're looking at as we look at benchmarks is, should we, rather than have it accrue as active performance, should we actually have there be various other factor inputs into the way we sort of harvest this equity risk premium that's different from the cap-weighted portfolio?
Mm-hmm. And then I wanted to I had a question around slide 20 also, which shows a large increase in the assets under management invested in the passive index funds or strategies. And it looked like a pretty sharp increase over a year. And just wanted to get a sense of whether this was part of the shift to the factor-weighted segments, and then are we going to see a commensurate, reduction in investment costs as a result?
So the answer shortly is yes and yes. So second segment is entirely index managed. So it's managed to replicate that index, and that has been the largest source of this shift in terms of more index and less active, because that came in a lot of ways from active strategies on the sort of the legacy cap-weighted segment. In terms of the second question on the fees, and this speaks to the line of questions that Ms. Olivares was raising last month, you can see that the fees are still at around that 9 basis points. That's actually due to some of the termination of legacy active managers, and then those fees crystallizing in this year. For next year, you should see going from a place of 9, I would try to be careful not to characterize it as a sharp drop in fees paid, but we would see that number coming down, and we would see that number coming down actually over the next, I would say, maybe 2 or 3 years.
Okay. Got it. And then slide 27, I had a question regarding the external cost increase from 33 basis points to 41, and want to get your sense of what the reasoning behind that is.
Yeah, and that's exactly what I was just referring to, is the fact that as we've terminated these managers, their fees crystallize, and when their fees crystallize, we pay them, but those will be, non-recurring costs, so to speak. Okay, good.
I also want to echo Ms. Taylor's comments about the strong focus on the sustainability and governance issues, and with respect to the new executive comp pay-for-performance model. Can you describe, and maybe this is Samiso, but some of the inputs that are incorporated in that model? And I guess what I'm really wondering is whether CEO pay ratio data is starting to get incorporated into some of our decisions on this front.
So yeah, this is a Samiso to dig into the details. Okay. I will just say, back to the previous line of questioning, this has been one of, we have lots of areas that we're trying to improve these companies, but I would say our 3 most critical strategic areas of focus are around climate change, and specifically the Climate Action 100+, board diversity, and then this executive comp. And I'll ask Samiso to talk in through the sort of the updates in the paper for performance and around our voting process.
That'd be great. Thank you.
Thank you for the question, Samiso and Zema staff. So in terms of the quantitative model that we use, which we introduced in March 2019, so there are 2 innovations that we did. Well, maybe innovation is such a strong word, but so if you look at pay for performance and what's in the market, most people look at 3-year period. So we actually decided to move to a 5-year period because we think 3 years is not a long enough period to assess pay and performance, especially when we talk about being a long-term investor. Even 5 years is not really, bad given the data. So we actually went out and paid to get the data to be able to look over 5 years as opposed to 3 years. The second thing which we did, again, which not a lot of people are doing, is to have this, what we call the CalPERS realizable pay methodology. So a lot of what is actually disclosed by companies in their proxies, they disclose granted pay or realized pay as opposed to realizable pay. So granted pay doesn't tell you anything about how pay moves with performance. So we actually came out and developed our own realizable pay methodology, which actually shows us how pay scales to performance over a 5-year period. And that, again, sort of helped us in terms of, from a quantitative perspective, to be able to quickly identify instances where pay and performance are misaligned. What we've also done, which we introduced in August this year, is what we call the CEO financial outcomes versus the shareholder financial outcomes. So what we've done, again, using our realizable pay methodologies to compare the returns or the gain in the CEO pay from grant date compared to the shareholder returns, over the same period. So, for example, if a company where we see a CEO pay has gained by 50%, whereas shareholders have only gained 2% over the 5-year period, that to us tells us there's something either in the pay structure, whether there's leverage and so forth. But I think one of the most important things which we have done is about transparency. Mm-hmm. And what we have actually done, we've posted a detailed explanation of our methodology to our public website. And the reason we're doing this is we want our investee, our portfolio companies, to be able to go in and understand how we are actually assessing pay and performance. We don't want this to be a black box sort of a situation. We want everyone to be able to do that. Companies can go in and look at that. Other investors can go in and look at that. They can give us feedback and say, you guys, you don't know what you're talking about. Or, they can say, oh, this is a good approach and we'll adopt it. So we've actually made that publicly available. We don't know any other investor who has actually made that publicly available. And we've made our model actually accessible to anyone. So it's hosted within the Equila platform. Mm-hmm. And we've said anyone who has access to that platform can go in and look at our model and put a company name and actually see how the pay and performance, is evaluated. So again, total transparency, because we don't want this to be a black box, and we think the value of that is when we engage companies, we really say, well, this is what the figures are saying, this is how you performed, and this is what you were paid, and these two things don't, they don't move in the same direction, they're not looking aligned. So that's really what we've done in there.
Okay, that's terrific. Thank you for all the work on the model. I just had a question with regard to whether the Sustainable Investments team will also have an opportunity to provide an annual review, or whether we're going to hear that incorporated in each of the program reviews.
The latter can still be incorporated in the program review. ISI is not an asset class, so it does not warrant a program asset class program review, but they are part of each of the asset classes.
Yeah, each of the asset classes. Okay, all right. And then I know we're going to be doing the reviews for the private asset classes in November, I believe. So
yes.
I just wanted to, Mr. Chairman, request if we could maybe have a similar report with respect to how we're doing with regard to board diversity as relates to the private asset classes as well. I know there's generally not a lot of attention with respect to diversity in those asset classes, but I think we're making such great progress on the public side, that I was really heartened to see that Equilar and our 3D database, which we have spun off to Equilar, we now have close to 20% women represented on the Russell 3000 boards, and that growth has actually been pretty significant over the last 2 years. So tremendous progress, but I'd like to also start to focus on that issue on the private side as well. So if we could just have a report on what we're doing with regard to those asset classes, and what further strategies we may be looking to in the future. And then I guess the question after this presentation is just really a question about confidence, and how confident you are about the ability of this portfolio to withstand potential market shocks, which of course is like asking you to read into a crystal ball, but given what you're seeing in terms of the performance.
So you're looking for answer now or in November? In terms of the drawdown.
Yeah.
So in terms of drawdown, I can say that it's probably that was the single most important question on each one of our mind of any waking moment of our time. Mm-hmm. We keep on working on that, and we try to get ourselves as ready as we can, as fast as possible. Yeah, and also, as you know, that there are so many sources of uncertainty out there in the world, and we try to be prepared for most of the scenarios. But even the first task to get a complete set of potential scenarios. But given the uncertainty, the unorthogonal events or potential events out there, so that's definitely pose a challenge to us. But you can rest assured, as I said, that that's the single most important question on the top of our mind.
Okay, thank you.
Yeah, I mean, the only thing that I would add is that equity holdings will get hurt. In the case of an equity drawdown, equity holdings will get hurt. But as Ben says, this has been a critical area of focus for Ben, certainly with focusing on our liquidity, focusing on driving this total fund perspective around the 4 utilities, with drawdown being one of them. And I would also say it's been a focus of the teams for a while. The segment work that we went through, getting to these asset segments in the 2017, I think it was, asset liability management work, getting an explicit treasury segment, getting a second segment of equity that's focused on mitigating severe drawdown. This has been an area of focus for the staff, but while recognizing that in order to achieve the kind of expected returns we have to take equity risk, and knowing that when we get that equity, that it's a when, not an if, we will get an equity drawdown, and when we get that drawdown, the portfolio will suffer. The idea is to be sure we can not only, to use Ben's terminology, first survive, but then secondly thrive, and that's been a major area of focus, certainly for Ben and for the whole team.
Yeah, I appreciate that. Thank you. And then just one last question, because I think for some of the newer board members, we had adopted the 5-year ESG strategic plan, and obviously in the process of implementing that. Seems to me some of that has kind of moved around a little bit, and so I don't know if we're going to kind of get an update, but in terms of what your top priorities for the next fiscal year is going to be, I suspect it's going to continue to be obviously some of the climate-related issues and then comp. But any other thoughts about priorities?
Correct. I would say that within global equity, the focus will continue to be those 3 areas: executive comp, board diversity, and climate action 100 plus. Okay. It is the case that we are continuing to execute on the ESG strategic plan, which also includes things like manager expectations, and making sure that all of our managers are incorporating ESG into their decision-making processes. And we've got a couple more years left on the plan, and we're continuing to execute.
Okay.
The only additional thing I'd add is that we are on track for this year's goals, one of which is, Beth Richtman, CalPERS staff, which is to deliver a real assets carbon footprint. As you know, we have a climate risk report that we're mandated to do by SB 964, and that footprint will be included in it. So that is one of the key goals that wasn't in the strategic plan, but is a very important stream of work for our investment office right now in terms of sustainable investment. It is doing a total fund climate risk report.
Okay. And I guess what I was asking is that maybe at the beginning of next year, if we could just kind of tie all those pieces together so we have a better way of just kind of tracking the remaining implementation of the plan.
Yep.
Okay. Thank you. Thank you, Mr. Chairman.
Thank you. Mr. Perez.
No, sir, I'm good.
Ms. Ma.
Thank you very much. And just to follow up on Ms. Taylor, SB 826 passed last year, signed by the governor, that requires at least one woman on a corporate board by the end of this year. And, my office has been tracking, and as of 2019, there were about 17% of California headquartered companies that still do not have a woman on the board. So I'm glad that you all are also looking, globally at the assets that we are invested in. But to follow up on Ms. Yee and market shocks and Mr. Meng on many uncertainties in the world, someone did ask me how much we actually invest in California, whether it's California headquartered companies, California real estate, so that we hopefully can weather whatever comes our way. And I'm not asking for an answer right now, but perhaps at the next meeting, if you are tracking that type of data, it would be helpful, because I think as we are all preparing for the future, we want to make sure that California remains the 5th largest economy in the world. So not for today, but maybe at the next meeting you can touch upon what our breakdown is for our different asset classes, if you have.
So we do an annual report on CalPERS investments in California, and we'd be happy to recirculate that to the board and get it out there, because it's actually a very comprehensive report on our investments in California.
Okay, great. Thank you.
Mr. Jones.
Yeah, thank you, Mr. Chair. Yeah, to Mrs. Ma's request on the impact, economic impact of CalPERS' investments and payments to its retirees in California. As staff mentioned, there is a report. Rather than just providing to the board, I think it would behoove you to make a presentation to one of the committees somewhere along the line about that report, because I think it's a very powerful report.
There's comment.
Yes, we'll bring that back to you.
Very good. Thank you. So you know the request. Anything else on item 8A?
that's all we've got for 8A, and we'll
All
move to
right.
8B.
So 8B is the Wilshire Associates summary. Till 9.
Good morning, Steve Foresti from Wilshire Consulting. I'm going to reference some of the material in the letter around the program review that we provided. I believe that's begins on page 303 of the PDF in your packet. And some of what I was going to review, you've just discussed, so I'll try to be brief in those areas. But I thought it would be helpful to quickly go through the process that we follow within the program review. Touch on the portfolio strategy, construction, recent performance, which you did spend a little bit of time on, and then finally touch on some of the commentary within our scoring model, which is part of the letter that we provided. There were some questions about that when my colleagues were here last month. It's the same model we use there, so I'll hopefully provide a bit of clarity on the construct of that model. But starting with the process, the letter that we provided really culminates in some on-site meetings that Wilshire has here with senior members of staff. We conduct interviews. It's on a variety of topics, including the research model that's followed, portfolio construction, implementation, attribution. But those on-site meetings really just build off of recurring conversations that we're having throughout the course of the year with the global equity team. And those calls essentially follow an agenda that lets us keep track of any strategic changes so that when we're on site at the end of the year doing the review around the fiscal year end, there really are no surprises. We're in constant touch with the team. That covers issues like staffing, again, strategy, portfolio changes, et cetera. Dan mentioned the affiliate investment programs, and while those are multi-asset in nature, they are part of the global equity program, so that's covered in the review that we did as well. And then final comment on process, and I mentioned the research model that we go through. It's the standard Wilshire manager research model that we would use when we're meeting with external money managers. So we run the team through the same sort of due diligence process we would if it were an external asset management firm. So with that, I'll just touch a bit on the portfolio construction and strategy. As Dan mentioned, the mandate of the Global Equity Program is to deliver global equity risk premia to the total fund, and then hopefully add some incremental return on top of that by taking modest levels of relative risk. And by modest, that's set to be between 0 and 50 basis points, or 0.5% of tracking error annually. So that's a modest amount of risk taking. And the goal, obviously, is to convert that relative risk into positive excess return. Obviously, one of the big initiatives through the last fiscal year was transitioning the portfolio from its previous benchmark of fully cap-weighted and moving into a segmented approach where 70% of the portfolio is cap-weighted and 30% is factor-weighted. And just to put some perspective around that 30%, with the size of the CalPERS portfolio, that translates to about $55 billion. So that was a massive, massive undertaking, a huge transition of assets. I think it was very prudently spread across the year. It was coordinated with the other asset allocation transitions that were happening. So it involved not just the global equity team, but the members of the team across the investment office and kind of quarterbacked by the TLPM team. So I'll touch quickly on performance because I know you spoke about that a bit in the earlier item. But as Dan mentioned, excess returns in recent times have been under benchmark. So for last year, it was about 0.2 under the benchmark, and that continues through to 3 and 5 years. As you stretch it out to 10 years, it's actually a positive excess return. Incidentally, in the letter that I referenced, if you look at page 3, we have some of those return targets. And then I think importantly on page 4, we show a rolling history on a 3-year roll of what both the returns look like, the excess returns, but importantly, we show rolling risk, and that would be the solid blue line in that exhibit 2. And you can see that with regard to risk-taking, that blue line has stayed very well within that 50 basis points of tracking error and has actually come down a bit, which I think is very consistent with some of the portfolio construction changes that Dan and team just described. In terms of portfolio construction, again, this is something that you just spoke of. Ms. Yee, you were asking questions about how much of the portfolio is managed internally, index-oriented strategies. There's certainly been a move to increase the amount of internally managed assets. That's very helpful in terms of maintaining the fee structure of the portfolio, and then index-oriented, which would be by definition strategies that take very modest, under 50 basis points, again, level of risk. Those increases in the portfolio have been funded by reduced levels of exposure to traditional active management, as well as to alternative beta. And I think the reduction in alternative beta is probably very consistent if you think about the shift to some of the factor-weighted approaches, that 30% of the portfolio that I mentioned, where there's been a little bit of a transition from where in the past staff used some of the excess risk that they had within their policy to lean in some of those directions. Now that's been, and I think very prudently done at a higher level with the investment committee's input and decision-making to set the strategic asset allocation process. I did want to make one comment because I think it's lost in the return numbers that I touched on for the past year. So we're one fiscal year into the transition to these factor-weighted portfolios, and we see that negative excess return that I mentioned of just under 20 basis points for the year. What's lost in that is the impact that 30% allocation. And to be clear, it wasn't 30% for the entire fiscal year. There was that transition into that allocation that I mentioned. But if you look at, I think, 1 year into the board's implementation of that segmented approach, there's some very good news around the way that segment has behaved and the role it's played within the portfolio. And specifically, if you look at the two components, the cap-weighted component, the portfolio's index, and that portfolio is just over a 5% return in fiscal 2019. The factor-weighted portfolio was well over 10%. So it shows you a buffer. And the point I want to make is I think Ben at the last investment committee meeting, mentioned in regard to this kind of strong and very positive looking performance that there will be periods of time where that segment underperforms. But that's different than saying it's betting against the market. And I think the numbers that I just revealed kind of demonstrate that this segment of the portfolio can perform, and it can perform well across a market cycle. And while it will have periods of underperformance, the goal is to make sure that in periods of sell-off, it can hold up kind of nice. If you zoom in on the fourth quarter of calendar 2018, that was a perfect demonstration of how that might play out, where the cap-weighted segment of the portfolio was off. I think the number is down about just over 11%. And the factor-weighted segment, it was down, but down just a little over 7%. So you can see that's a bit of the protection that can happen in some of those market sell-offs. Finally, I just want to touch on some of the scoring. And this would be on page 6 of our letter that just shows the model. And before getting into commentary about the various components, I would just draw your attention to the very bottom of the exhibit on page 6, which kind of has a coloring scheme around the scoring process. And as my colleagues Ali and Rose discussed when providing summary on the program reviews for opportunistic strategies and TLPM last month, it's the same scoring model. The 1 through 10 are tiers or deciles. If you think about if we scored every asset manager that's out there, you would expect to see essentially an even distribution across the component score. So 1/10 would have a 1, 1/10 would have a 2, et cetera, et cetera. We simply attach letter grades to those numbers just to try to move a little bit away from the granularity that a 1 through 10 scale suggests, and kind of collapse it down to, if you kind of think about a 1 and a 2 as an A, to bring it again to letter grades, a 3 and a 4 a B, so on and so forth. So every grouping of 2 tiers would essentially move you down to letter grade, 5 and 6 being essentially median in the middle type of score. So with that framework in mind, we go through the scoring model that Wilshire employs, which looks at scoring organization, information, forecasting, how's that information built into forecast, portfolio construction, how are those forecasts put into a portfolio? Implementation, how is that paper portfolio implemented and traded? And then finally, a really important part, which is attribution. How does the process learn from itself? What's the feedback loop? How does the process learn from previous investments, and how does that feed the go-forward investment strategy? So, stepping through that, I won't go through each component, but I will draw attention to a couple of things that we commented on in the letter. As far as the organizational level, we did push the score up, and the organizational score has two components. One is organization-wide. Think about that across the whole investment office, and then there's a team component. So organization-wide, no change to what Ali and Rose shared last month. That score was pushed up a bit, and that's, in fact, because we brought it down the previous year. When we put the score together, that's when the then CIO was leaving. There was uncertainty about that position. That's obviously been filled with Ben, so that pushed the score up, even against the issues with the departure of the COIO. But that brings me to the team, and I'm happy that it came up in the previous session, and we commented on this in the letter. The global equity team is very deeply resourced. There's folks that have been with the organization for quite a while, very seasoned, very experienced team. And I think that played very well into the investment office being able to tap into the team and Dan's role in moving in and being able to fill the interim COIO role. And that really became that flexibility, I think, is a testament to the team. And then Dan being able to, I think he's talked about the hours he's put in, but I don't think that's possible without him being able to rely on a really experienced team that is, we've talked about this not only this year, but in previous letters. There are redundancies built into the process. So every person on the team, not to say this in a pejorative way, but is replaceable and has redundancies. And I think that's a really important risk control. And the organization has benefited from it in certainly this calendar year. Other strengths of the program, for sure, construction and attribution. I mentioned the importance of those. The very robust risk tools that are not only available to the team, but they've demonstrated that they're using very extensively. They understand the positions that are in the portfolio. They understand why the excess returns are negative. So I think there's very little surprise in the return pattern, but of course that doesn't guarantee that the excess return is always positive. But it's a well-constructed, well thought out, well understood risk portfolio. The other strengths just within the team, you talked a bit about corporate governance and the team the process that Samiso leads, fully integrated corporate governance team that they can just integrate and be independent in terms of proxy voting and shareholder engagement. That's a huge benefit. I know you talked a moment ago about program reviews around some of those functions as well as sustainable investing. Just as a reminder to the committee, it may not be a program, but it's been a review that Wilshire's conducted. My colleague Daniel Ingram for the last 2 years has provided an overview and a review of the sustainable investing program, and that's something we're prepared to do in whatever format makes sense for the committee. Finally, I'll touch on a couple of areas where our score did come down a little bit. One would be forecasting. And I think that's not because we have any significant concerns about the forecasting process, but it's just a natural response to when you do see over the short term some of the relative return numbers moving from black and into the red and trailing the benchmark. That's just a signal that it's an area that we're keeping an eye on and in the interim lowering the score a bit. Again, I mentioned the portfolio construction and kind of understanding the nature of that negative return, but nonetheless, it does bring some questions around the sustainability of those insights. And I think the way Dan responded to your question is the same way we would think about it, which was a very, I think, humble and sober response about, trying to understand, has the world changed? Is this something that comes back in terms of delivering the sorts of relative returns that it has historically? Finally, the other place we lowered the return was in implementation. Implementation is a strength of the program. We simply reduce that because in this 30% factor-weighted component, there is reduced liquidity in terms of trading that segment of the portfolio. Staff ran into that when they were transitioning into the portfolio. They are completely not only aware of that issue, but have actually taken steps. There was an internal project. They provided us with transparency in terms of the nature of that project, what problem it was attempting to solve. And this is probably an example of what you talked about earlier in terms of what constitutes materiality around a benchmark change. This is a perfect example, I think, in practice of one of those cases where staff came to Wilshire, identified what they were working on, again, gave us transparency into that process, and allowed us, as your independent consultant, to opine on whether we agreed that those were ministerial changes in nature, that in essence, that factor-weighted component is still delivering the risk characteristics that it was intended to do. And I would expect that our implementation score in next year's review, provided we see that the implementation of these changes have been successfully, they get at the problem they're trying to address, I would expect to see that mild reduction in score move back up next year. So it's probably a little longer than what you were looking for, but I'll be happy to answer any questions you may have.
Thank you. Ms. Taylor.
Yes, thank you. Thank you for your report. And you kind of touched on what some of the things I was going to ask about. Organizationally, the score, I know you said is the same as last time, but I wanted to kind of dive into that a little bit. I thought last time the score was kind of low because we had some disruption in our having our CIO leave, et cetera. So what are you seeing as a problem now that keeps the score low for organization for the firm part? Not the team part, the firm part.
Yeah, so the score actually did come up a bit from last year. So we lowered it last year, and I apologize. I'm legally blind. If I'm not pointing at you, I couldn't tell where the question was coming from. But so we did increase the score this year. The reason it stays essentially where it is are based on comments that we've provided in the past. And again, but I think more on the micro level, just there still is at the senior level uncertainty, and that would be around the COIO role, which is now being filled in an interim basis. Again, I kind of told you the positives around that in terms of the flexibility that the organization has, but at its core, that helped dampen the score a bit for sure, albeit against a big positive of filling the CIO role. But I think CalPERS just as an organization just has the impediment of competing for talent in an industry where ownership and incentive packages, there's just more tools available in the private sector. And that in no way, and I commented on this last year, no way impugns the talent level of the staff, but I think it provides just a little bit less kind of retention certainty around some key individuals. And we've just seen some of that turnover at senior levels in recent years. So that I think keeps a lid on that overall score, but it is up from last year a little bit.
Okay, so and that's what you meant here by our inability to provide employees direct and indirect ownership opportunities, correct?
Absolutely.
And then on to the team score, which is unchanged. Turnover is mitigated through positive, intellectually challenging work environment. So here it sort of translates when we're looking at the positions underneath the senior management. You're saying that we have a better handle on how to retain those folks, basically.
I just through an interesting collaborative environment. So I didn't touch on the structure of the decision-making process, but it was very much a committee driven approach. So that's not to say that decision-making in the portfolio is democratic in any way, but it's democratic in terms of opinions being raised, people having ownership for different elements of the portfolio in a very inclusive decision-making framework. And I think that keeps people engaged, and that serves as a really important, I think, retention tool. I mean, if people are interested in the work they're doing, they feel like their contributions are meaningful, then, outside of the monetary compensation that one receives for the work that they do, doing meaningful work, I think, is important. So that's the nature of the comments that you just read were designed to kind of try to call that out, because I do think it's an important part of what goes on within the global equity team.
Okay, thank you. Also, when did you guys do this review? Just curious.
So we were on site in mid-July, but as I mentioned, we have calls at a minimum every 2 months with the staff, and more often than that when needed. I gave you the example of the factor weighted. That happened outside of these recurring calls, and that's just if something material is going on, then we'll get on the phone. But the 2-day on-site was in mid-July.
And I guess why I'm asking is because we've got the new CIO, and I know you said that you raised the score, but it didn't raise it enough to get us up there to a B. So, and then we hired the PE, private equity director, managing director, and fixed income. So was that included in this score?
So everything that would be, so keep in mind also the score is based on fiscal year 19, so it'd be inclusive of the things, based off of that. So we're scoring the program as of through that fiscal year. But yeah, it would be including all information, including what we're aware of as we're doing the review.
I think timing was fair to say both Greg Ruiz and Arnie Phillips was named at MID after the fiscal year.
That's what I was trying to figure out. Okay.
Right, but Arnie was in the role. Right, so the scoring would have represented Arnie in the case of fixed income, Arnie being that role, but
as acting though.
Yeah.
Okay. All right. Thank you.
You bet.
Mr. Perez.
Thank you. Following up on Ms. Taylor's questions, under the firm, there's 3 criteria that you have listed: the quality and stability, and then quality of the organization, and then ownership and incentives. To what extent at all did the ownership and incentives affect our score?
That's a big component. So the quality of the staff, I think, is very strong and can compete with best in class organizations in the industry. So the main impact on the score, and again, it's because what these scores reflect is not necessarily a problem, but a risk. And the issues that we address in the area of retention and compensation is a risk. You have a very talented investment staff, but it's just a risk that there could be disruption because of those aspects. Now,
Yeah, I asked a goofy question, I'm sorry. I meant specifically for the ownership and the incentives. How did that affect our score?
that's the reason it's other than the specific turnover, but the risks around that is the reason it's low.
Turn your mic on. The ownership and incentives is about 40% of the total organization score. It's 30, 30, 40.
Please identify yourself for the record again, please.
Rose Dean, Wilshire Associates.
Thank you. Ms. Oliveras.
Thank you.
But it's that 40% that really brought
Microphone, Steve.
Oh, I thought it was on. Yeah, I was just commenting on it. So that's tangibly gives you the weight, but the score to that component is, with that 40% and a low score to that component, is what brought the overall score to where it is.
Mr. Price, I may have an opportunity later this afternoon in closed session to address ownership and incentive question.
Ms. Oliveras.
Thank you. I'm used to seeing a higher weighting for organization, usually because that, in the private sector, which I know this isn't, that's the secret sauce, right? You compete based upon your talents, based upon the performance of your organization. But I've seen that also with some other states and their pensions, as well as some counties. Why is the weighting 20% for the organization level?
So let me talk a little. So the weighting that we use actually is a bit dynamic. So the 20% reflects when the score is median or above, and completely agree with the sentiment that you're raising, which is all of the other components can be as high as you like, but if there's a low score at the organization level, how does that trickle through to the overall score in a way that's appropriate for that concern? The way we do this, and by the way, we do the same thing on the forecasting score, because I would also argue that you could be best in class in portfolio construction, but if your forecasting is really subpar, there's no portfolio construction in the world that's going to fix the problem with forecasting. So we have a dynamic score, and the way it works, without getting too into the weeds, if the organization score overall is 5 or above, meaning median or above, then it's 20%. That score starts to become a bigger and bigger component of the overall total score as it deteriorates. And I don't have all the details in front of me, but essentially it goes from 20 to 30 and go all the way up to, I believe, 70% of the overall score if that score comes really low. So it kicks in almost, if you think about it, as a circuit breaker. So when the score is median or above, 20% seems appropriate. When it starts to deteriorate, then it should, I think, importantly, have an impact on the overall score. So that's the way we've designed it to make sure that it does serve as a circuit breaker and a warning that there's something that other components just simply cannot make up for.
And just to add, Rose Dean, Wilshire Consulting. If, for example, a material event happens to the organizational structure in terms of ownership, et cetera, or to the team where a key member of the team is leaving the firm or leaving that team, then that score would come down, in which case that would kick it to the dynamic portion that Steve mentioned, so that we can properly reflect that in the overall score of the strategy.
Thank you. And then I see that we've looked at the quality of the team, and I know we've talked about compensation packages for executives. Are we also looking at compensation for the investment officers that do a lot of the work, so that we can increase the pool of talent that we have feeding into executive positions?
So in terms of incentive compensation, some of the investment officers are included, not all of them.
Yes. Are we looking at changing the compensation structure for all the investment officers?
So we're looking to change the compensation structure for some of the investment officers currently who are eligible for incentive compensation.
Ms. Taylor?
So you may not know that's rank and file.
I do.
Okay, so then the compensation is being discussed or has been discussed at bargaining. So and then this extra bonus that they're talking about, I think, is something we did at bargaining recently.
Okay.
And Ms. Oliveros, I can give you a full background on some of the work that the board has done to extend the compensation ranges for the positions in which you have the control to set pay. Mm-hmm. And then I can also give you an update on where negotiation is on more of the line level investment officer positions.
Thank you.
Yeah.
Anything else, Ms. Oliveros?
No, thank you.
Ms. Middleton?
Thank you, Mr. Chair. I'm looking at this report and I see a number of areas where the scores are extremely high and very successful. Moving forward, what is it that you think needs to be done to have the success we're having in these areas translate into organization and firm success?
With regard to our evaluation process, I would think some of the conversations that Ben alluded to that are happening. To us, it's about the risk of stability in process and team. And I mentioned the attribution part being critical to learning. That learning erodes when similar lessons, for example, might need to be learned again because there's been turnover. Now you have you've not seen that in recent years in the global equity team. There's been good stability at senior levels within the global equity team. But I think that stability is critical to the attribution loop of an investment process leading to positive results rather than kind of giving ground and having to go back and retest things that were attempted in the past. But I don't, in terms of our scoring, I don't think there's anything that we would draw a lot of attention to or a lot of concern around. We just note the issues that are there. But the biggest one is around those organizational issues. And that, not throwing that in your lap as if it's something that's easily solved. It's just pointing out a potential risk that's in place. And it's been a common point in our letter for years.
Great, thank you.
I would just add, we have reflected some of this in this year's review, but there has been improvements that have been put in place in terms of taking a more centralized view and getting rid of any inefficiencies and redundancies across different asset class silos. And as those plans get implemented, we believe that would be actually a positive improvement going forward.
All right, thank you.
Mr. Perez.
By and large, I'm happy with our grades, and thank you for the evaluation. This next question is probably, do any of the other firms or bodies you represent, do they include some kind of evaluation or scoring for the board? Because we are a team, the board and the CalPERS staff is a team. And I'd like to see where we can improve.
To my knowledge, we have not, I'm not aware that we've done any sort of project like that, other than we provide, feedback in terms of, Andrew earlier was able to share perspective around a benchmark question that came up because of just the kind of the broad set of clients we work with and kind of identifying best practices and common uses. I think, we could provide that same sort of high-level insight just in terms of different approaches that various boards use, but in terms of a formal scoring model, it's just not something that we've done. I'm sure there's organizations out there that perform that sort of task, but it's not something that we've done or we have an off-the-shelf scoring model for.
I mean, just to add to that, we are your consultants, so if there's any feedback that we believe you need, that would happen obviously on an ongoing basis as we interact with the board through education or informal feedback.
Yeah, no doubt. You guys are excellent and very responsive. But I wanted to know that we are on the same wavelength as the team and going forward together, not working against in any fashion. Is there any way to quantify that?
Quantify that, you mean relative to other boards?
Give us a grade.
I feel like you're more in the position to grade us than the other way around. But I think it's, to Rose's point, it's feedback. We'd be happy to share feedback. I don't know what the best format to do that in. The comment I made is that we don't have a formal model like I just stepped through in terms of doing the investment process. But I mean, that'd be something that'd be interesting to kind of consider. I just don't know what the best format could be, but we certainly could be helpful in terms of sharing what we see that works particularly well or sometimes doesn't work well in certain organizations. I just don't know what the best format is to provide that feedback.
Anything else, Mr. Perez?
No.
Thank you. Mr. Miller.
Yeah, I think kind of to follow on to Mr. Perez's question, it seems that we've got a board evaluation process that we do with NACD, and it resulted in recommendations, some changes that we're working on, some work streams to improve our effectiveness and performance. And so perhaps that's an area that, as our consultants, you could give us some feedback about how well that's serving us in terms of those work streams, that work, that approach, and also how we could better kind of integrate that with the information we're getting via the work you're doing vis-a-vis the organization and staffing and everything to try to make the whole thing a little more seamless.
All right, seeing no other requests, Ms. Yee.
Sorry, I just want to weigh in on this last point. Thank you, Mr. Chairman. This is the question Mr. Perez is posing is exactly kind of the capability I'd like to see on our insight tool being developed in terms of communication between our consultants and the board. And that was kind of the parallel, I guess, platform that I wanted to see built so that we could have more ongoing sharing of information from our consultants. Thank you.
Thank you. Seeing no other requests, anything else on this item? Steve, anything else? No? We're good?
Good, thank you.
Very good. All right, with that, before we move on to item 8C, we're going to take a 10-minute break for the court reporter.